Good morning, everyone. Welcome to the Commodity Weekly Analysis with me, your host and guide Ravindra Rao from Kotak Securities. Well, volatility is super high across financial markets as the markets are purely driven by the developments in the Ukraine. We are yet to see the end of it, which means that volatility may continue and the markets are going to remain very fragile. In general, we saw a shift from riskier assets to safe havens as Russia and Ukraine tensions continued. Increasing energy and commodity prices has also unnerved market players due to its impact on inflation and economic activity. The US dollar index was the beneficiary as it gained from for second week in a row and jumped to fresh 21-month high close to 99, supported by safe haven buying. Strong non-farm payrolls data from US further supported the greenback. Precious metals had a good week as they clearly behaved as a safe haven asset in this time of uncertainty. Gold ended the week over 4% higher at $1970 and silver closed nearly 6% higher at $25.70. Continuing with the gains, gold at the start of this week has had breached $2,000 per ounce spot basis for the first time since August 2020 as Russia-Ukraine tensions intensified. Apart from safe haven buying, gold has also benefited from increased demand as an inflation hedge. Russia is a major player in commodity market and supply risks has pushed commodities higher. Gold has risen also as market players have reduced possibility that central banks may act aggressively as increased geopolitical tension and higher commodity prices threaten economic activity. However, rising inflationary pressure and strong US jobs data makes a cause for Fed to continue with monetary tightening. MCX gold has hit multi-year highs as gains in international market coupled with weakness in Indian rupee has supported the metal. Indian rupee depreciated 1.2% against the US dollar last week amid weaker risk sentiment and rising crude prices. Rupee has weakened further this week to move towards all-time lows. Silver has also risen along with gold amid the uncertainty, and it has even industrial metals has supported the silver prices. With continuing war of words, imposition of sanctions, and no progress in talks, it seems difficult that tensions may subside soon. While no resolution is likely in the near term, market reaction may subside only if there are genuine efforts to resolve the dispute. Overall, we expect COMEX gold to trade in a range of 1941 to 2030 an ounce, and while volatility may remain high, the general bias may be on the upside unless there are sincere efforts to resolve the issue. On the technical side, spot gold is trading close to $2,000 an ounce. It is currently trading near 1990, 1992, and it is getting good support, and there is a good possibility that it might move towards 2030 immediately, and might test the all-time highs near $2070. However, we have to be a little cautious as any resolution to the geopolitical tension might trigger some kind of a correction. On the lower side, support remains near 1960, 1950, and if that is taken out, it might further move lower. Otherwise, the bias remains positive. On the MCX, 52,000 to 51,900 remains a good support, and on the higher side, 54,500 to 55,000 is a possibility. But as I mentioned, one has to be cautious and keep a close watch on the news. In case of silver, silver has tested 70,000 on MCX, and it looks pretty strong. Possibility of it hitting 72,000 is high. On the lower side, 66,000 remains to be a good support. Below that, the trend might slightly change to neutral. Otherwise, it looks positive. Coming to crude oil, oil has marched higher. Is continuing to do that as the Ukraine war continues. Supply is going to be disrupted, and the market knows this very well. Last week, WTI rallied a staggering 25%, closing just under $115 mark. The gains intensified at the start of this week, with WTI crude hitting a high near 130.5 per barrel, and Brent testing around $139 per barrel. Market players are worried that if tension escalates, supply from Russia may be impacted. Russia is one of the biggest crude oil producers in the world, along with US and Saudi Arabia, with production of over 10 million barrels per day, which is nearly 10% of world supply. US and other Western countries have so far refrained from directly targeting energy sector. However, restrictions on banking and shipping are making trade activity difficult, and this has upended the energy market. Backwardation in crude market has steepened significantly owing to the near-term supply worries. European crude prices are trading at a sharp premium amid reduced supply, while Russian crude is trading at a discount owing to lack of buyers. Meanwhile, companies are reducing their exposure to Russian market, fueling worries about future supply. The pace of gains intensified since Friday last week, as US and allies have indicated a willingness to consider ban on Russian energy exports, but wants to keep market well supplied. If Russia is restricted to transact in global market, it may lose export revenues from oil and gas exports, which may severely hamper economic growth. At the same time, lower supply from Russia may further tighten global energy market and may worsen the European energy crisis, as US LNG exports may not be able to offset completely the loss of Russian supply. Currently, market players are focusing on supply side risks. However, increased geopolitical tension and soured relation between major economies also threatens to impact economic activity, which may challenge demand growth. Weaker risk sentiment also has already caused investors to pull out of riskier assets, and if risk sentiment weakens further, crude oil and other commodities may come under pressure. Overall, supply risks are looming high, and this may keep prices supported. However, volatility may remain high as market players also assess the demand scenario as well as general trend in larger financial markets. Also, the rally in crude shows to some extent market has factored in that Russia's exports may be targeted. It looks to trade in a broad range. Possibly, the bulls might target dollar 147 again, which is the all-time high in case of WTI crude. It is trading close to dollar 120 per barrel currently. 115 to 114 dollar zone was very crucial. It was multiple resistance, and it has breached that, and it is sustaining above that. So as per the charts, it looks like the bulls might target the all-time highs. But as mentioned earlier, one has to be very cautious. Any resolution on this front, on the geopolitical front, might trigger sharp profit booking, and the profit booking might deepen till dollar 100 or dollar 90 as well. So one has to be very cautious while trading crude oil, and better to trade intraday. One should refrain from carrying overnight positions, because we have seen the sharp gap up and gap down openings in the Indian markets. So one has to be very cautious. On the MCX front, crude has come close to 10,000 levels, and there is a good possibility that bulls might target those levels, provided uh, the, uh, the tensions remain and it escalates. But if any resolution is seen, then we might see some kind of a corrective move, which might deepen till 8,000 to 7,800 as well. Finally, coming to base metals, even last week base metals witnessed record rally gains on weekly gains on fears of supply disruption, coupled with rally in energy prices amid escalation of tensions in Ukraine. Nickel has seen a meteoric rise, while aluminium jumped to all-time highs as markets were concerned of further supply tightness, as intense Russia-Ukraine spat puts Russian metal exports at risk. Base metal is expected to trade with positive bias, again, like other commodities which are impacted because of the Russia-Ukraine spat. However, one should be very careful, and I am telling, please be very cautious. Please don't carry any positions overnight. Better to trade intraday and square off the position intraday, because we have seen a few cases of sharp gap up opening, and a gap down opening, so one can get trapped. So it is always better either to stay away from the market for some time till the issue subside, or refrain from trading positional, and better to trade intraday. So to conclude, focus this week will be on developments in Ukraine. If things escalate, then the risk off will continue affecting financial markets while driving commodity prices higher. Although economic data releases will not have much of an impact in the current environment, however, traders would want to look at the ECB's monetary policy meeting, as European economy is more exposed to risk associated with Russia. Also, important inflation data from US and other countries will be released. So that's all for this podcast. Good luck and trade safe.